Group Statements, Chapter 7, Examples 7.8 and 7.9. Before we look at the detail of these examples, I just want to focus again on some basic principles behind the preparation of consolidated financial statements. And it's based on what you see in front of you. When we prepare consolidated financial statements, we prepare that as if it's one new single reporting entity. My starting point for each amount in the consolidated financial statements is calculated as follows. I start by taking 100% of the parent's trial balance item. I add to that 100% of the subsidiary's trial balance item, and I adjust that if necessary for the effect of consolidation journal entries. Each consolidation journal entry achieves a certain outcome. For example, my at-acquisition consolidation journal entry achieves the following. It eliminates an amount from the trial balance of the parent, the investment. It eliminates amounts from the trial balance of the subsidiary, the share capital, the retained earnings, the revaluation surplus. It creates new items like NCI and goodwill or gain from bargain purchase. That at acquisition journal entry only happens in the consolidated financial statements. I'm not changing the separate financial statements of P or S. Another example, the Intra group dividend journal. I eliminate the dividend income from the other income of the parent, but not in the separate financial statements of the parent, in the combined line item total other income in the group. I eliminate the dividend declared by the subsidiary. And if there's NCI involved, I change the NCI balance in the group. All of that happens through consolidation journal entries. Each chapter in Introduction to Consolidations introduces new consolidation journal entries based on different economic events, based on different requirements from my IFRS that regulates consolidated financial statements, being IFRS 3 and IFRS 10. Now the same principle applies in Chapter 7. Chapter 7 is all about the subsidiary's net assets that have to be fairly valued at acquisition date. So my focus is to start looking at the TB of S as my starting point. All the assets and liabilities in that TB must be fairly valued in the group. It doesn't have to be fairly valued in the separate financial statements of S because we have the cost model available in standards such as IAS 16 and IAS 40. But in the group, it has to be fairly valued. And the reason for that has been explained in video 1 of Chapter 7. Please revisit that again. So now, if this asset is not fairly valued in S, and S cannot fair value that, you need consolidation journal entries to change the value coming through from the trial balance of S. And that's the focus of Chapter 7 is what are the line items in S that's now different because the carrying amount of the asset is different for group statement reporting purposes. The thought process to follow is then to say, what did S do? What should the amounts be in the group? And if you have any differences because of that, you write your consolidation journal entries. The suggested work method that we're using in every example thus far has helped quite a bit by identifying those differences and then leading up to the required consolidation journal entries. Example 7.8 and 7.9 now focuses on value adjustments or revaluations of depreciable property, plant and equipment of the subsidiary at acquisition date. One of the most important principles to remember when we're busy with a depreciable asset's value that we adjust at date of acquisition is that the depreciation for the group should now be based on this new revalued amount of the asset. Therefore, if the subsidiary does not recognize this revaluation in its own accounting records before we consolidate, there will be an additional depreciation expense that should be accounted for by means of consolidation journal entries. These additional depreciation journal entries will affect my non-controlling interest in the subsidiary's profit for the year, because an additional depreciation expense will lead to a change in the group's profit, and it's ultimately the subsidiary's profit we change, which is included in the group profit. So my starting point, being the trial balance of the subsidiary, would include depreciation based on the cost of that asset in the separate financial statements of S. But because the carrying amount is now different in the group, we will have to add that extra bit of depreciation through consolidation journal entries. Some additional factors to consider. The revaluation surplus that arises at date of acquisition because of this necessary value adjustment to your property, plant and equipment eliminates in the group through the at acquisition consolidation journal entry. So whether it existed in the separate financial statements of S or whether it was created through a consolidation journal entry, the at acquisition equity of the subsidiary eliminates in full. This portion of your revaluation surplus can therefore not be realized in the group at a subsequent date. This principle was also addressed as part of example 7.1, and you can refer to part 3, the video on example 7.1 part 3 that looks at this principle. Then a subsidiary can account for this revaluation at date of acquisition in its separate financial statements, but only if it applies the revaluation model. But as we've mentioned before, it still does not have to account for that value adjustment. It depends on its own accounting policy in terms of the timing of revaluations. Because we now have an increased value on my depreciable asset, there will be additional depreciation. And this additional depreciation for group statement purposes is determined with reference to the remaining useful life of this depreciable asset on the date of acquisition and not the total useful life. The fact that the value of the depreciable asset has changed does not automatically imply that the useful life of the asset is different from the original estimate. If there is a change in estimate, that information will have to be communicated in a test scenario. Always remember that consolidation journal entries are not accounted for in the separate financial statements of either the parent or the subsidiary. So if I have additional depreciation necessary in the group, I'm not changing the depreciation or the profit in the separate financial statements of S. But my consolidation journal entries do, however, affect balances at the end of the year. If you have additional depreciation, that would affect your closing retained earnings as well as the closing carrying amount of the asset. And the opening balances in the following year should be equal to the closing balances in the previous year, in the group statements as well. Since my consolidation process commences every year, with my starting point being the parent's TB and the subsidiary's TB, where, for instance, that additional depreciation has not been accounted for, the necessary consolidation journal entries will be necessary to get my opening balances in line with my prior year closing balances. And we will look at examples of that, specifically for examples such as this additional depreciation.